Hello, ladies and gentlemen. Welcome to another episode of Trading for Life. PPI and CPI both came out, and despite all the tariff noise, the market is holding up. But remember, tariff impacts usually show up after about 4 months. No one's really talking about a recession anymore, but there's still a lot to unpack. So if you enjoy trading like we do, make sure to like and subscribe. Let's get into it. While Fed funds futures still reflect expectations for 2 rate cuts by December, the broader bond market is shifting. After the June CPI report, the initial bond market reaction was muted. But now, rising yields suggest the market believes the Fed may need to keep rates higher for longer. According to economist Lauren Henderson at Stifel, there may be just one cut in Q3, and the window for any 2025 cuts is closing. Inflation data clearly shows price acceleration in tariff-sensitive categories like furniture, toys, and appliances. Reports that President Trump was planning to fire Federal Reserve Chairman Jerome Powell sent stocks and the US dollar tumbling on Wednesday, while long-term Treasury yields spiked higher. The panic didn't last long. Less than an hour after Bloomberg broke the story, Trump told reporters at the White House he had no plans to remove Powell. Stocks quickly recovered and turned positive. However, bond and currency markets remained cautious, with investors less willing to reverse course. New York Fed President John Williams said Wednesday that Trump's new tariffs are adding to inflation and could boost it by about 1 percentage point through early next year. Despite market volatility driven by rumors Trump might fire Fed Chair Jerome Powell, which he later denied, Williams and other Fed officials maintained a calm tone. Atlanta Fed President Raphael Bostic said he was not focusing on political noise and noted the recent CPI report showed the highest monthly price increases of the year. The Fed is widely expected to hold rates steady at its July 29th to 30th meeting, though economists like Tim Dye believe Powell is setting the stage for possible cuts in the fall. Williams added that the Fed's preferred inflation gauge, the PCE index, likely rose in June, reflecting continued inflation pressures. Wall Street expects the Treasury to ramp up its year-old buyback program this month to help bring down long-term yields. President Trump is again urging the Fed to cut rates, citing low inflation and up to $1 trillion a year in potential savings. Meanwhile, Treasury Secretary Scott Bessent is focused on pushing down 10-year yields, which remain high despite last year's rate cuts. Long-term rates matter. They affect mortgages, car loans, and government borrowing costs. Bessent has been seen as a steady hand, but his strategy may be tested by Trump-era inflation fears and rising deficits. The 30-year yield hit 5.04% this week after reports Trump might fire Fed Chair Powell, though he later denied it. Higher long-term rates act as a drag on the economy and could keep debt costs elevated. I'd like to see an all-time high soon, as the S&P 500 in yen terms hasn't yet convinced me that this is a strong bull market. The current pattern still resembles setups that have preceded major risk-off moves. I believe we're at an inflection point, driven by the yen's continued significance, movements in Japanese yields, and the potential unwinding of the carry trade, as previously discussed. Watching this closely, many stocks are lagging the market's rally. Only 50% of S&P 500 stocks are trading above their 200-day moving average, near the low end of the 2024 range and 7 points below this year's peak of 57%. Similarly, just 63% are above their 50-day moving average, down from 78% in June. This divergence comes even as the S&P 500 hits new all-time highs. As a result, the equal-weighted S&P 500 has yet to break its November 2024 high. Big tech continues to carry the market. This is incredible. NVIDIA, NVDA, now makes up a record 4.73% of the MSCI All-Country World Index, ACWI, which covers about 85% of global equities. That means NVIDIA alone has a larger weight than Japan's 4.65% share, despite Japan being the world's third largest stock market. For context, the UK holds 3.28%, China 2.97%, and Canada 2.87%. Nvidia's weight is now nearly equal to France and Germany combined. Historic might be an understatement. The market saw it coming. Over the past week, odds of Fed Chair Powell being out in 2025 rose from 12% to 26%, with no news driving the move, according to Kalshi. Today, the White House confirmed that President Trump is likely to fire Powell. Following the announcement, those odds jumped to a new high of 38%. The market is watching closely. You should too. Retail investors are increasingly driving the market. Retail's share of total single-stock trading volume has reached 14%, the highest since at least 2018. This even surpasses the 12% recorded during the meme stock frenzy of 2020 to 2021. By comparison, the average over the last few years has hovered around 10%. Individual investors' top holdings are Nvidia, NVDA, Apple, AAPL, and Tesla, TSLA, at $472 billion, $284 billion, and $256 billion, respectively. In other words, retail investors own over $1 trillion in just 3 stocks. Do not underestimate the power of retail. China's property crisis is worsening. New home prices fell -0.3% month-over-month in June, the steepest monthly drop in 8 months. Prices are now down -3.2% year-over-year, marking the 24th straight monthly decline. Second-hand home prices dropped -0.6%, the biggest slide since September 2024. Residential sales plunged -12.6% year-over-year last month, the sharpest drop this year. Real estate investment fell -11.2% in the first half of 2025, the lowest since the 2020 pandemic. The downturn in China's housing market is accelerating. Vanguard now owns a record 20.6 million shares of MicroStrategy, making it the company's largest shareholder. That's roughly 8% of all outstanding shares, and double what it held just 2 years ago. The buying has come across a wide range of Vanguard mutual funds and ETFs, tracking everything from small and mid-cap indices to momentum, value, and growth strategies. Institutional capital is piling into Bitcoin, one index at a time. Global fund managers are rushing into equities at a record pace. Cash allocations have dropped to 3.9%, the second lowest level in 12 years, per a BofA survey of 175 managers overseeing $434 billion. It's the third straight monthly decline, down from 4.8% in April. At the same time, portfolio risk levels just hit a record high, going back to 2001. Notably, allocations to tech stocks saw their biggest 3-month surge since 2009. Bullish sentiment hasn't been this strong in years. All right, ladies and gentlemen, that's all for this video. If you enjoyed it, please give it a like and subscribe. Thanks for watching. And if you have any questions, drop them in the comments. I'll get back to you. Bye for now.